I have watched people make the same mistake for decades. They think the job is to find a great company. That sounds sensible. It even sounds wise. But it is only half the job, and half of the job done badly is often worse than no job at all. A great company is not automatically a great investment. A famous company is not automatically a safe investment. A blue chip is not automatically the best place to put fresh money. What matters is whether the business in front of you can keep compounding value, whether it can do it with strength instead of strain, whether it can survive disappointment without begging the capital markets for mercy, and whether you are paying a price that still leaves room for a satisfactory outcome. Most people do not think that way. Most people begin with admiration. They see a familiar brand, a stock that has been around for years, a name that pays a dividend, a logo they recognize from the grocery store, the phone in their pocket, the credit card in their wallet, or the software on their office computer, and they assume familiarity is safety. Then they move one step further and decide that safety must also mean value. That is where trouble begins. The stock market is full of businesses that deserve respect and still do not deserve your money at the current price. There are also businesses that deserve less applause, less television coverage, less cocktail party status, and yet can produce far better results because the numbers, the economics, and the expectations line up in your favor. When I look at a so-called blue chip, I am not asking whether it is beloved. I am asking whether it is durable, whether it is growing for real reasons, whether it converts that growth into cash, whether its balance sheet can absorb a storm, whether management is allocating capital intelligently, and whether the current valuation already assumes a future that leaves me with too little upside for the risk I am taking. That is a much tougher standard than simply buying something famous. It is also the only standard that protects you when the market stops being generous. A real blue chip usually has a long record of profitability. It tends to throw off strong free cash flow. It usually carries an investment-grade balance sheet, or at least a balance sheet that behaves like one. It has some competitive advantage that is not easy to copy. It has scale. It has customer relationships, switching costs, habit, network effects, trusted brands, cost advantages, distribution power, or some combination of those things. It is not living quarter to quarter on hope alone, but that is still only the beginning. Plenty of businesses qualify as blue chips and still fail the more important test, which is this: are they the best buy today? That question offends people because it forces them to separate business quality from investment quality. They do not like doing that. It is easier to say, but the market does not pay you for stopping there. The market pays you when your understanding of future cash generation, durability, and price is better than the crowd's understanding. I have seen people buy Coca-Cola because they know I bought it many years ago. I understand the instinct. They see a dominant brand. They see decades of dividends. They see stability. What they do not see is that the price I paid and the business maturity of that era are not the same as the price they may pay now or the growth runway that exists. Now copying an old winner without understanding the starting valuation is not imitation. It is carelessness wearing a respectable suit. Investing is not a museum. You do not get paid for admiring old masterpieces. You get paid for buying future cash flows at an attractive price. So when I study a blue chip, the first thing I want to know is whether the top line is still alive. I care about revenue growth because revenue tells me whether demand is real. Earnings can be polished, costs can be cut, share counts can be reduced. One-time items can flatter results. But if revenue has not grown for years, I want to know why. Sometimes there is a perfectly rational explanation. A mature business can still be excellent without rapid growth. But if the story is supposed to be expansion and the revenue line is asleep, then the business is either more mature than people admit or weaker than they realize. A useful discipline is to examine 5 years of revenue growth and ask whether the company has been growing because customers genuinely want more of what it sells, or because accounting, acquisitions, and price increases have made the picture look cleaner than the underlying demand really is. I prefer businesses whose sales growth comes from habit, utility, embeddedness, rising usage, and pricing power that customers accept because the service is essential or the brand is deeply trusted. Revenue growth does not need to be heroic. It needs to be believable. A modest rate of growth backed by real demand is better than an exciting rate of growth purchased with fragile economics. Then I look at return on invested capital, because this is where the truth about a business often reveals itself. A company can grow and still destroy value if it needs mountains of capital to produce a modest stream of returns. Another company can grow steadily while needing very little capital and create tremendous value because each dollar retained inside the business comes back wearing a much larger hat. That is what high return on invested capital tells you. It tells you the company has some combination of pricing power, operational excellence, intangible assets, scale, network effects, or disciplined management that allows it to earn unusually good returns on the money committed to the enterprise. This matters more than most people think. If you own a business that can reinvest at high rates for a long time, compounding does much of the heavy lifting. If you own a business with weak returns on capital, growth can become a treadmill. You run harder and harder and still do not get very far. Investors often confuse activity with economics. They see expansion and assume value creation return on capital separates the two. That is why companies like Visa and Microsoft have historically attracted so much attention from serious investors. Their economics are not good by accident. They scale in ways that do not demand equal increases in capital. That is a precious trait. It means more of the revenue can become cash for owners instead of being swallowed by the machinery required to keep the enterprise alive, which brings me to free cash flow. I have never been interested in earnings that refuse to turn into money. Cash is what gives a business options. Cash pays dividends, cash funds, buybacks, cash finances, acquisitions, cash builds new products, cash carries a company through recessions when weaker rivals are forced to retreat. Cash lets management act from strength instead of from necessity. When free cash flow rises consistently over time, it usually means the engine underneath the accounting is healthy. It means customers are paying, operations are functioning, investment requirements are manageable, and the business is not merely reporting success, but actually producing owner earnings. Many businesses look respectable until you open the hood and see that the cash is thin, erratic, or permanently spoken for. Those businesses can become dangerous when credit tightens or growth slows. Most corporate disasters do not begin with a low opinion on television. They begin with a cash problem. That is why I want to see whether a company can convert its revenue into cash year after year, and whether that cash is rising for the right reasons. If free cash flow is improving because the core business is strengthening, I pay attention. If it is improving because management has slashed necessary investment or because working capital has temporarily flattered the number, I become cautious. The quality of the cash matters as much as the quantity. After that, I go straight to the balance sheet. Debt is like oxygen in reverse. When you have enough flexibility, nobody talks about it. When you do not, it is the only thing anybody talks about. A good company with a strained balance sheet can become a miserable investment in a bad environment. Refinancing arrives at the wrong time. Interest expense grows teeth. Management decisions become defensive instead of intelligent. Buybacks disappear. Acquisitions vanish. growth plans shrink, and equity owners who believed they owned a stable blue chip suddenly discover they were standing behind creditors the whole time. So I want to know how much debt the company carries relative to its equity, relative to its cash generation, and relative to the interest burden it must service. I want to know whether the enterprise could live through a recession, a temporary margin hit, or a period of slower demand without pleading for capital on unattractive terms. The strongest companies do not need perfect weather. They need enough financial resilience to survive ordinary storms. This is one reason I have long admired businesses that can throw off consistent cash while carrying manageable debt. A company like Procter Gamble, for example, benefits from demand that does not vanish because the economy gets moody. People still buy daily necessities. That stability supports the balance sheet. In investing, resilience is often worth more than excitement. Then comes the question almost everyone handles badly. Valuation. People say it matters, then act like it does not. They fall in love with a story, a brand, a chart, a recent winner, a famous name, or a comforting dividend history, and they start treating price as an inconvenience rather than the central variable in the decision. That is a wonderful way to own excellent businesses at disappointing returns. A great business at a fair price often beats an amazing business at a crazy price because your return depends not only on what the business does, but on what the market already believes it will do. When expectations are too high, even a fine company can become a poor investment. A business can grow, report good results, and still produce mediocre shareholder returns because the stock began from an inflated base. That is why I compare current valuation to the company's own history, to its growth profile, to peer alternatives, and to the actual cash that flows back to owners. A price-to-earnings ratio by itself is not enough. A business growing at a superior rate can justify a richer multiple. A business with exceptional durability, high returns on capital, and strong cash flow can deserve more respect than an average enterprise. But there is always a line beyond which you are financing your hopes instead of buying a bargain. I care whether the market is charging me a premium for quality that I will never recover through future compounding. This is where many investors make their most expensive errors with blue chips. They assume safety means any price is acceptable. But safety purchased without valuation discipline is not safety. It is complacency. If you pay too much for maturity, you can spend years earning less than you expected, while the business itself performs perfectly well. Once I understand those core economics, I try to place the company in its broader environment. The economy does not determine everything, but it influences which strengths matter most at a given moment. If you believe the world will continue spending heavily on cloud infrastructure, enterprise software, and artificial intelligence, then a business like Microsoft deserves careful attention because it combines balance sheet strength, high returns on capital, ecosystem entrenchment, and exposure to powerful technology tailwinds. If you believe consumer ecosystems and device loyalty still create durable value, Apple becomes a serious candidate because it sits at the center of a habit loop that few rivals have matched. If you believe volatility, higher rates, and global payment growth will continue to reward fee-based networks with scale, then Visa can be compelling because each swipe strengthens a system built on trust, reach, and efficiency. On the other hand, if you want resilience in a shakier world, you may lean toward businesses like Johnson & Johnson or Procter & Gamble, where demand is tied more closely to health, hygiene, and daily routine than to economic fashion. These are not identical opportunities. They express different kinds of durability. One may offer stronger growth, another may offer steadier defense, one may deserve a higher multiple, another may deserve your patience during a storm. The point is not to own whatever sounds most exciting. The point is to understand what kind of durability you are buying and in what environment that durability becomes especially valuable. Then I perform what I think of as the 10-year test. I ask myself whether this company is likely to remain important 10 years from now. Will customers still depend on it? Does it possess switching costs? Does it enjoy brand loyalty? Does it sit inside a network habit workflow or daily routine that makes replacement difficult? Does it have room to reinvest at attractive returns? If the stock fell 30% next month for market reasons rather than business deterioration, would I be comfortable owning more? That last question is a test of understanding, not bravery. If a decline would terrify you, there are only two possibilities. Either you do not or you paid a price so foolish that even a normal drawdown feels like an indictment. In either case, the problem is not the market. The problem is the original decision. People say they are long-term investors until the market offers them a discounted price on the thing they claim to love. Then suddenly they become weather forecasters, macro pundits, and chart technicians because they never owned a business in their mind. They owned a hope attached to a rising price. Real blue chip investing is supposed to calm you, not excite you. It should make you more selective, not less. That is why I tell people to avoid 4 common errors. The first is buying a stock simply because it is famous. A famous company can still be overvalued, mature, or entering a slower phase of life. Fame is not a margin of safety. It is often the reason the margin of safety disappeared. The second error is chasing recent performance. A stock that has risen sharply may continue rising, but that is not analysis. That is memory masquerading as insight. I would rather own a strong business whose next decade is attractive than a recent winner whose prior 12 months have convinced the crowd that no price is too high. The third error is ignoring valuation because the company feels safe. That is how people buy quality at a level that condemns them to low returns. The better the company, the more likely the crowd is to overpay for comfort. Discipline matters most where affection runs strongest. The fourth error is concentrating too heavily in one fashionable sector. A portfolio packed with whatever worked last year can feel intelligent right up until the cycle turns. Then investors remember, often too late, that different sectors carry different economic sensitivities, valuation norms, and disappointment risks. Diversification by itself is not brilliance, but avoiding needless concentration is common sense. There is another mistake that deserves mention because it hides behind good intentions. People let old holdings stagnate. They bought something years ago. It performed reasonably well. They never revisited the thesis. They never checked whether the competitive advantage is still strong, whether valuation changed, whether capital allocation weakened, or whether a better opportunity replaced it in the world. They call this patience. Often, it is simply neglect. I have no objection to holding a stock for many years. In fact, I prefer it when the economics justify it. But long holding periods should result from durable business quality, not from intellectual laziness. Every position in a portfolio ought to be able to answer a question. Why do you still deserve this capital today? If you cannot answer that question clearly, you are no longer investing. You are storing ticker symbols. A practical way to think about all of this is to build a mental scorecard, not a mechanical formula that substitutes for judgment, but a disciplined framework that forces you to compare opportunities. Honestly, take 5 companies that many investors would call blue chips: Microsoft, Apple, Visa, Johnson & Johnson, and Procter Gamble. Now ask the same questions of each. On revenue growth, the technology businesses may show stronger expansion because they benefit from software demand, ecosystem spending, enterprise adoption, and digital tailwinds. Apple and Microsoft can still find large pools of customer spending because they sit close to hardware, software, services, productivity, and infrastructure. Visa grows differently. Its economics are linked to payment activity and secular movement away from cash. Johnson & Johnson and Procter Gamble may grow modestly, but their demand can be steadier because it is tied to health and daily consumption rather than to product cycles and corporate budgets. That is why growth must be interpreted, not merely measured. A slower growing company is not automatically worse if its cash flows are stable, its valuation is sensible, and its resilience is unusually high. Likewise, a faster growing company is not automatically better if you are paying a price that assumes heroic execution for years. On return on invested capital, businesses like Microsoft and Visa have historically stood out because their models scale efficiently. They do not need to lay railroad tracks across the continent every time they want to grow. Their systems, software, and networks allow increasing revenue to fall through to attractive economics. That is the kind of business investors should study carefully, because compounding is much easier when the enterprise itself is built to convert incremental demand into superior returns. On free cash flow, Apple has long been a remarkable case study in the power of a huge ecosystem coupled with a business model that converts a great deal of consumer demand into cash. That cash creates options. It supports repurchases. It supports innovation. It supports resilience. It lets the business do more than survive. It lets the business choose on debt. Microsoft and Visa have often represented the sort of balance sheet cleanliness that gives owners confidence. A company does not need zero debt to be attractive. It needs debt that can be handled comfortably under less than ideal conditions. That is a very different standard from simply reporting that debt exists. On valuation, none of these companies can be judged in a vacuum. Visa may trade at a premium because predictability deserves respect. Microsoft and Apple may look expensive to a casual observer and perfectly rational to a serious one if growth, capital efficiency, and durability justify the price. Johnson & Johnson or Procter & Gamble may appeal more when investors crave stability and less when speculative enthusiasm dominates the market. Context matters. History matters. Growth matters. Price matters. Everything must be weighed together. This is why stock selection is difficult. People want shortcuts. They want a famous name, a comfortable story, and permission not to think very hard. But the market does not consistently reward laziness. It occasionally rewards it by accident. That is not the same thing. If you are going to choose individual blue chips instead of simply owning a broad index, you need to know why each one is in your portfolio. You should be able to explain the demand engine. You should be able to explain the competitive advantage. You should be able to explain the cash generation, the balance sheet, the valuation, and the reason the next decade could still be productive for owners. You do not need to predict every quarter. You do need to understand the machine. When I hear someone say, "I own this stock because it is a great company," I am never satisfied. That sentence is unfinished. A better sentence is this: I own this stock because the business has durable demand, high returns on capital, growing free cash flow, manageable debt, a long runway or strong resilience, and a valuation that still offers a sensible return relative to alternatives. Now we are finally talking like owners. It is also helpful to remember that not every investor needs to play this game. For many people, a broad market fund is a perfectly intelligent solution. If you are unwilling to study businesses, unwilling to compare valuations, unwilling to revisit your thesis, or unwilling to sit calmly through downturns, owning a diversified index may be wiser than pretending you are a stock picker. There is no shame in that. The shame lies in taking concentrated risks without doing concentrated thinking. But if you do choose individual businesses, then choose them with a standard worthy of the task. Do not buy a blue chip because it has a reputation. Buy it because it has economics. Do not buy it because someone wealthy bought it long ago. Buy it because the future cash flows available to you today still justify the price you are paying today. Do not buy it because the chart looks comforting. Buy it because the business can remain useful, strong, and intelligently managed for a very long time. Do not buy it because the dividend feels like proof. Buy it because the whole enterprise can compound value. That is the frame I would use. I would start with the business itself. Is it truly a blue chip by economic standards, not by reputation alone? Does it have years of profitability, a real moat, global scale, strong, free cash flow, and the sort of balance sheet that can handle stress? Then I would ask whether the revenue growth is authentic. Is demand real? Is the business expanding because customers want more or because management is rearranging the furniture? Then I would ask what the return on invested capital says about the quality of the moat. Does the company produce excellent returns because the economics are naturally strong or because a temporary tailwind is flattering the picture? Then I would follow the cash. Is free cash flow rising? Is it resilient? Is it funding intelligent capital allocation? Then I would inspect the debt. Could the business survive a harsh environment without needing help? Then I would discipline my optimism with valuation. What am I paying for this quality? What assumptions are already embedded in the stock? What happens to my return if the business is merely good rather than perfect? Then I would step back and ask whether this company fits the world I believe we are entering, whether it still passes a 10-year ownership test, and whether I would feel comfortable owning it during a sharp drawdown. That sounds like a great deal of work. It is. That is why great investment results rarely come from casual thinking. The world is full of people who want certainty. Markets do not offer certainty. They offer the chance to be rational when others are rushed, disciplined when others are excited, and patient when others confuse noise. Blue chip investing, done properly, is not glamorous. It is simply the repeated act of choosing durability, economics, cash generation, resilience, and sane pricing over popularity, impulse, and stories that flatter the ego. The best blue chip is not the one that makes you feel the safest in the moment. It is the one that gives you the strongest combination of durability, growth, financial strength, and valuation discipline over time. That distinction is everything. It is the difference between owning a name and owning an engine. It is the difference between borrowing conviction from somebody else and building conviction from your own work. It is the difference between a portfolio that merely looks respectable and one that can actually compound. And in this business, compounding is the only applause that matters.